Okay, welcome everybody. Now we've just started recording, and I guess it's Wednesday, January 11th, and I'd like to thank Matt for all the technical prowess, and Ryan, and everybody else for getting this going, and also, of course, very much Capital Discussions for facilitating us getting this. And so we're going to, we've been through some individual strategies for options trading in considerable depth, and I'm sure we've lost a lot of people as we step from one to the other. And so I wanted to go back and do a global review, or overview rather, of the strategies that people are using and the ways you can access them if you want to trade option income strategies. Can I ask how many people here are already trading any sort of option income strategy? That is great. And some of the strategies that I'm going to go over briefly are John Locke's M3, Dan Harvey's Road Trip, Jim Riggio's Kevlar, Andrew Faldy's Zero Delta, also Weirdor and Fruitfly and Bearish Butterfly, Super Simple Spreads, John Locke, which Tom pointed out to us as something of value. And another one is Rhino. How many people? Well, I think the best thing to do is, as we go through each one, and it's only going to be a quick overview, for anybody who's trading that, to indicate, and we ask them to maybe make some comments if they want us to, as to how they're finding it, or whether they would recommend it, what other strategies they looked at, or whatever. And before we get into that, let me, how many people are already familiar with these venues, Capital Discussions and SMB Options and John Locke? How many people already frequently or occasionally use any of those forums? That's good. Not that many people, though. So let me go over what tremendous resources these are, and starting with Capital Discussions. And Ryan, do you want to say a little bit about Capital Discussions? I know you use it, and Ryan is a real devotee of it, and he has introduced me to the depth at which it's possible to follow that and the value you can get out of it. So if you want to say a few things.
Sure. I mean, Capital Discussions is fantastic. They have they have many different trading groups that meet, and they're all very interesting to listen to. I listen to Trading Group 2 quite a bit, and it's a group of guys who do a lot of options trading, butterfly trades, all kinds of different strategies. But what's nice about Capital Group Discussions is they also have, not only are they constantly talking about their trades that they have on and different ways to hedge trades and different market conditions and what sort of play to put on under this condition versus that condition, but they also talk. They also have many different speakers that come on and speak with the group, and it's, a lot of times those engagements are very interactive, and it gives the community an opportunity to ask questions. They have a very active forum. There's some forums there for newbies. That was once a newbie, and there's some great forums there that are just way over my head. Statisticians are talking about volatility, mathematics and everything else that I just can't even understand. But these guys probably have been studying this for years. So no matter what your experience is in options trading, you definitely can find a place at Capital Discussions.
And the nice thing is, it's free, and including the recordings. And now you have to pay a nominal monthly fee if you want past presentations in PDF form. But if you want to look at them in video, I honestly believe that that would be your best single source for learning options, because, as Ryan mentioned, they have such a huge number of different speakers. And incidentally, it's not either or with these education venues. It's because the same speakers move between all of them. So you'll hear Amy Meissner, on Capital Discussions. You'll hear on Options Tribe. But I honestly believe it's a far, far better bet for those of you who are less less experienced, and many of you are more experienced. But for those of you who are less experienced or just learning, just getting into it, and I think that's your best route. And the best thing to do is listen to them all. Or each week they have Market News, they have Trading Group 2, and they have a roundtable, which is a feature speaker. And maybe one of each normally. So if you just want to, and you'll quickly learn too, which are the most popular strategies, which are right now, at least on Capital Discussions, Road Trip, and what else would you say?
Oh, a lot of people trade the M3.
Yeah.
That's very popular. I think any kind of butterfly-based strategy
Mm-hmm.
is very popular, and there's several of them.
Mm-hmm. Yeah. And another one that I really recommend is SMB Options Tribe. Now, this is once a week on Tuesdays, and it has really prominent speakers who are associated with Options Tribe and SMB Capital in New York. And there's a huge library of prior talks, and you can view that for $30 a month, but you can take a free trial and go through the whole library, speed watch videos for a month or for a month or two, so you can get enormous value. I think this is a longer standing. In other words, Capital Discussions is a newer venue. This is a very long-standing one. I am raving about Andrew Faldy, who is a less-known speaker, a less-known instructor. He really isn't an instructor. That's not his goal at all. He's a trader. He's leading options. Well, one of the two leading. These are the two leading. The first two listed here are the two leading options traders for SMB Capital, John Locke and Andrew Faldy, and they both give a lot of talks. Now, every now and then they'll go over to Capital Discussions and give a talk there too. But if you want to really get into it in depth, this is the place to go. You don't have to go back that far, actually, because Andrew Faldy had LRC before, and now he's changed a little bit. He's not following that. Linear regression channels he used to use, and now we found simple moving averages are good enough. So, and more responsive. They don't have to be simple moving averages. You can use exponential moving averages, various other types of moving averages. And the third one that I was going to mention is John Locke's weekly update. And I'll give copies of these slides, so you don't have to write anything down. But it may take me a day afterward to put that together. But you'll see that he has a majority, or not a majority, but a plurality of methods of options trading strategies that are widely used. Now, so you can watch those live every Tuesday, and if you want back versions, you can either pay $30 a month, I believe it is. That might be incorrect, amount, and see all history. You can see all of history but the past 2 or 3 weeks anyway on YouTube for free. So it's sort of these curious combinations across different platforms as to what's free and what isn't. So those are the 3 I would recommend. Who here would recommend a different one or has any further comments? Do people use videos a lot? Look at videos a lot on options? Yes.
For a while, I was listening to, what was it called? Options Insider Radio. It's a
Oh,
podcast.
okay. I think I know that one.
Yeah, they have,
Options Insider Radio.
yeah, they have a really good options boot camp,
Uh-huh.
and you can.
Okay. Boot camp.
Yeah, it was. It's not done in any particular order, but you can kind of
Mm.
just go through them all or sample
Yeah.
them or whatever.
Uh-huh.
I thought it was a pretty good way to learn.
Yeah, I mean, the truth is that for these introductory concepts, like maybe boot camp might be, or more elementary, you can get a lot of different sources and you still get the knowledge, whatever suits your taste. Who had another, or who has any opinions on these videos, sources, these? Yes, Michael.
Well, I will just say that TD Ameritrade,
Mm-hmm.
yes, videos, a lot of them are little 5-minute
Okay.
videos. They're not, I'm going to analyze this whole trade for you, I'm just going to tell you
Uh-huh.
how to sell a put.
Yeah.
5 minutes and you're in and out and done.
I think you can get a lot of value from the TD Ameritrade Thinkorswim. And also, what's that other platform they have, that other
Tasty trade.
Tasty Trade, yeah. And they're starting another one as well.
Tasty
Works.
What is it?
Tasty Works. It's going to be.
Tasty Works. That's a brokerage they're starting.
It is.
Yeah. They're starting their own brokerage. Having sold everything to TD Ameritrade, I guess the non-compete period has expired. So they're going to start their own.
Has anyone here got a Tasty Works account yet?
Do you?
I'm in waiting. Because
Waiting for them to start up.
well, they're up, but
Okay.
they're only about 10% of the demand satisfied yet. But the fees
Oh.
look about half of what TD Ameritrade is.
What are the fees?
Dollar per auction.
$1 per
And
option.
No close costs.
On this new brokerage that has been started up by the founder of Thinkorswim.
But that seems to be not the most important part, was the fact to help the independent, self-directed investor.
They're more self-directed.
Yeah, and all of the, you just go in there, do a search, and usually you'll hit up on something very simple, quick, in their glossary
Mm-hmm.
or in their, what do they call it? Getting started series.
Mm-hmm.
Usually
Okay.
15 minutes or less.
Mm-hmm.
I understand that their software is not going to have the analyze function that Thinkorswim has.
That's
So that might be a deal killer for some of you.
Yeah, but you can just use Thinkorswim as well.
could.
Until Thinkorswim gets wise to this and that's the greatest danger in all this. That Thinkorswim says, the heck, we're not giving away our platform software anymore. And that's another topic I have here too.
If you trade SPX options, they are not publishing that. They do not include the exchange fees
Their
on
futures
top.
won't be until March.
Well, no, their SPX commissions is not including the exchange fee, so it's a little bit more expensive.
Oh.
Like
Yeah.
65 cents per contract, I believe,
Mhm.
on top of the $1 or $1.25.
Dave,
whatever
could
it
you
is.
possibly check out the sound and see if we're picking up these people when they talk in the back, in the middle of the room?
The new
Just over time, thanks.
But as far as the learning and education
Mhm.
part, I found that, for me,
Mm-hmm.
at least, that's where I bootstrap that from that.
I'll also mention that all these different websites or communities that we're talking about all have mentoring opportunities where you can pay
Yeah.
a nominal fee to be mentored by a pro for a number of months.
Do we have an in-house, like, website where we post what books we found most helpful for things like this?
Do we have a website where we post what? Sorry?
Where we post like different books or different like this, like online of, like, what we.
You can do that on the forums.
Yeah, we
on the
have
Meetup
forums.
group.
Okay, so it is,
There's the discussion forums. You have to be logged in to see them.
okay.
So you can start a new thread. I don't know if there's one on books or not.
On books? Yeah, by all means, please start a thread on books, yeah. It's an interesting discussion. I mean, books is another whole topic. I didn't attempt to deal with it here, but I think we may have some in the past discussions. Yeah, please don't hesitate to do that. And
Educational resources in general.
yeah, well, it's true. It's just a limited amount of time that you can, we can cover in one meeting, and we could come back to that possibly in another meeting. And let's see. Oh, geez. See, I told you, Ryan, you should
Take over.
operate it. I got to keep my fingers away from
Just that.
just the page down, yeah. But I want to go back sometime. Page up, page down. Okay. Hey, Pat, but Thinkorswim is free for options platforms, but if you really want to get into analysis, then what people use is OptionView. If you're willing to pay $100 a month. Runner-up is OptionNet Explorer, and a whole bunch of people have switched to that now. As we're seeing in the various videos, we look at them, a whole lot of people are using it. It's much cheaper and it's much faster. It doesn't have futures options yet, only stock.
They might have just introduced that.
They're just on the cusp of introducing it.
On the cusp,
Maybe
yeah.
it came out like yesterday or
Right, or
something.
like last week or something.
Okay, if they do, then yeah, I'd love to take a look at that.
Johnny, you can make these slides available.
Yes, yeah, we will have the slides available. Sorry, I didn't hear somebody ask that. And,
Will there be a link someplace?
pardon me?
A link?
They'll be on the Meetup site. He'll make them available.
We'll put a link there, yeah, at the very least. Oh, no, you don't need to. And now there's special hidden offers for both, so, don't just call a vendor. If you're interested in either OptionView or OptionNet Explorer, which have the in-depth analysis with all the Greeks, and most of all, they have better backtesting than Thinkorswim. Thinkorswim is absolutely fine for most analysis, and so, people prefer it. Ron Bertino says it's better. It's his standard. But if you want to do certain types of backtesting, then these come in. Michael?
OptionNet Explorer, is this web-based or is?
No, it's a very nice, fast desktop application that just zooms. You make a change. I got a trial of it, and there's some nice trials offers out there.
What if OptionView is $100 what's OptionNet?
I think you can get around 60 or
Okay.
so. It depends on the course of the British pound. It's has British origins, although it's also tied into Dan Sheridan. But have you looked at it at all?
I use option.
Yeah, it's still the standard as of now.
It's not less than 1,000 a month, or 100 a month.
Mhm. Pardon me?
It's less than 100 a month.
You can get it under with special offers, but by the time you add on the quote fees, and I mean, in some cases, you can get the quotes from your other platforms. You
Yeah,
have.
the cheapest way to do it with real-time quotes is through Interactive Brokers, and they may support some other brokerage platforms as well.
Thinkorswim, I believe
Yeah,
they do
probably.
support either of those, but people who use those say that the data gets gated or slowed, but if you can cut down your number of quotes you're getting,
Right.
people say it's adequate, and it's free. So it's better than the $35 a month or whatever you're going to pay for quotes. And so, those are the brokers, the platforms. You can think of all, and I'm just going to go through these and get comments on the different strategies. It's a survey of them. We already know, as Ryan said, the leading ones are probably M3 and Road Trip. But that doesn't mean those are the right choices for everybody. Those are just the most popular. But we can certainly simplify your choice if you just want to go with the volume, which is often the right choice to make. And both of these, moreover, M3 and Road Trip, can be sourced. You don't have to pay. If you want a quick introduction, a course, structured course, you have to pay. But if you want to do it yourself, Road Trip is totally open. The inventors of that, they don't hold anything back at all in their webinars. You can just look at the webinars, look at the 2 or 3. This was Ryan's webinar that he gave on Road Trip. But M3, you're going to have to. It's almost open, but not officially. So you'll have to, look at a bunch of. But John Locke has given like about 89 webinars on M3. He does weekly reviews of it. I would say that M3 is still the broader known quantity. With John Locke giving his weekly reviews, I don't think there's a weekly review of Road Trip. Well, in a way there is, because it's all I talk about on the Trading Group 2, or it's one of the main things every week. So you could look at that and see what everybody's doing on Road Trip. But now you decided, Ryan, to go with Road Trip initially.
Actually,
is that right?
Yeah, I traded the M3 for a few months, and so I have a full-time job, and it just was consuming a little too much of my time. I think it's a great strategy. I'm definitely not knocking it. It's very popular, but it just was a little bit more involved for me than the Road Trip. And with that being said, I know that there's some advanced Road Trip strategies that are probably too involved for my taste, at least the amount of time that I can dedicate to it during the day as well. So it really just depends on, what suits you.
I'll throw in a little compare and contrast here. I took John Locke's M3 course, and I learned a lot. But the part of the reason I went away from it is really to trade it right, you need a planned capital of $50K. And that's, I trade several smaller accounts, and that was a little much for me to put into one trade. And so you can, there are ways to trade it smaller. You can trade a one lot, but it's a bit cumbersome, and it limits your adjustability trying to trade this one small. It's also can be adjustment intensive, which is difficult in Thinkorswim. If you don't have option view and you're trying to do it all in Thinkorswim and you have a small account, you might look at some of the other trades. But I learned a lot from John Locke. It's well worth getting on his mailing list, and if you can tune in, he does a Monday morning kind of recap where he goes through some trades that he does with class, and he'll throw out his take on the current market every Monday, and so that's a really good resource. So I've learned a lot from John Locke, but I'm really not trading the M3.
I learned a tremendous amount about the Greeks in trading the M3.
Yeah, they don't talk about the Greeks so much with Road Trip, explicitly in any case. And so, but you really, it's sort of one community, and if you listen to some of the forums, a lot of people say, well, I have a couple of M3s on and one Road Trip, or I've switched, from one to the other, or and people also say that M3 isn't doing so well right now, and road trip is doing better. But you have to be a little wary of some of this because John Locke has said that M3 has been tested through huge crashes, including 2008. I mean, he's sort of got a penalty on it with this. Well, it's basically he has a long call to protect against the gradual, what would you call it? Those markets where they just climb relentlessly slowly upward, because these are very hard markets for these trading systems. And he has it biased with a long call, which he biases down around 95 delta, I believe. And that in the money, basically a position in the underlying. It's a surrogate for owning the underlying, so that so that he can. That is not present in most of the other versions, and is not present, I believe, in Road Trip as such. So they may struggle a little bit more when you have this grinding up market, which we have right now. And
Don, without having a deep in the money call built into it, how does it perform in bear markets?
Mark?
Well, without having the deep in the money call, it's just a straight up symmetrical butterfly, which has a bearish bias, just the way just the way your T+0 line sets up. So yeah, I mean, if you were, one possible adjustment, if it was breaking to the downside, would be just get rid of your long call. But it does leave you open to whiplash if the market reverses on you.
Yeah, I mean, a lot of, really, is in a sense all the same trade. It's all a butterfly. Almost all of these systems, and they have different little gimmicks to handle different little idiosyncrasies of the market. M3 has the in the money long call, and I guess it's not a broken wing. It's symmetrical.
Yeah, it's a symmetrical butterfly with a long call, and it's a deep in the money call. I think you use about a 80 to 90 delta in the money call, which is pretty expensive. So, and then the ratio of calls to he's got a 10 lot butterfly there is the base position, and so if you try to trade smaller than a 10 lot butterfly, you'll find that you're way too positive delta with one long call, and so there lies the problem. Then you can use IWM calls as one way around that if you want to trade smaller than a 10 lot. It gets very cumbersome keeping track of all that.
Couldn't you replace the deep in the money call with a portion of actual underlying?
I suppose you could if your delta lines up. Yeah, it's essentially delta neutral trading. So when you start out, you'd like to be close to zero on your delta.
You're going to have to keep adjusting those.
Right.
It would just consume more capital though if you bought the underlying.
Yeah.
So this is really a strategy that if the market's going sideways, from what I'm looking at the chart.
Yes, it does, but the ideal situation theoretically is if the market ends up at the peak of this tent.
Well, yeah.
That would be the max. Now that doesn't happen, and they don't aim for it, and they take it off before they get anywhere near there, because the reality is this dotted line here shows what the current profit will be if the underlying suddenly T+0, time +0, instantly moves to to these strikes that are shown on the bottom.
My only question is,
Mm.
rather than this strategy, would a back spread not be more sufficient? Or is your loss going to be less in this compared to a back spread strategy?
A back spread is a very particular strategy that will lose money in general, I think. Well, I don't know, but I doubt it has a positive expectancy. So, you tell me.
I don't know, that's why I see a loss if it goes too far to the upside, I see a loss if it goes too far down, so too far behind you.
Well, they make adjustments. What they do is,
How do the adjustments work?
let's see now, the adjustment would be, let me see if I have that. M3 adjustment points, yeah. They look at the delta of the overall position. And if it gets outside too far from zero, then they make an adjustment. If it's, and the guidelines are what? Minus 50 and minus 100. Well, these are some of the adjustment points. What are the adjustments they would make, Mark?
Well, there's all kinds of different ways. You know, if you find yourself too far negative delta, then you would add a positive delta trade in, like a bullish debit spread in the calls would be one way to correct that. So, you know, that would be one strategy. If it's going too far to the upside, you need to be more bullish, and so you'll add in. Well, that was what I just said.
Split your short strikes.
Yeah, I mean, you can do that too. You can split the short strike and move your the upper half of your butterfly higher up, and basically turn it into like a condor. What else? You know, the problem I found with all of this, though, is increasing your capital outlay. You're already maybe leveraged out to get, you know, a 10-lot butterfly along with one long call. Then all of a sudden you need to make adjustments, and you're pumping more and more money into the trade. You're basically overlaying your existing trade with other trades that help balance out your delta. And then you have, you know, a whole stack of positions that you're looking at the graph, and yeah, it just can be very cumbersome without the right software. If you're not using OptionView or OptionNet Explorer, forget it.
Or because of the awkwardness of just getting that.
Yeah, I think so. You know, I tried to trade that way for a while, and Ryan came up with some good workarounds to keep track of your adjustments. But with Thinkorswim, if you were to move a leg, okay, so one possible adjustment is your upper long strike. You can move it one way or another, and it basically turns it into a broken wing, and you can dial in your deltas that way. And you know, with Thinkorswim, if you were to do that, Thinkorswim essentially forgets that you ever owned that leg. Yeah. And so then your graph is meaningless. And so you have to have your entry for the purchase of that leg, and then the sale of that leg, and then the purchase of the new strike. And first thing you know, you've got 30 different entries there that you're trying to keep track of one trade. And so, I mean, it's very doable if you have one of these more sophisticated software packages. But if you're just using Thinkorswim, you know, it's worth studying this approach. I've learned quite a bit from John Locke, but I don't think you can do it on Thinkorswim.
Interject.
Tom?
Yeah, if I'm using Thinkorswim, and there's some tricks.
Right.
And I think you can, if you get your mind set and you use these tricks properly, It's almost as easy as optimal.
Yeah.
It keeps track of the proper truck.
Okay,
I mean,
You have some special spreadsheets for that, I think.
no, I do it on the platform.
Okay.
I mean, watching some of their videos, I've watched some of the guys that use Thinkorswim,
right,
and they turn off the real trade
right,
and leave the simulation to them.
right,
Everything works out perfect. And if you get used to that,
right,
it's not that much trouble.
okay,
And it took me a while to get my mind around it, but it's quite good.
right. Well, I spent about 6 months attempting to trade that way, and I got frustrated,
Okay.
and I said, I'm moving on.
Okay.
Yeah, okay. I mean, we're never going to get everybody doing exactly the same thing. Before we go any further, I guess we should ask if people understand what this trade is. Ron, do you want to explain maybe what this?
Sure. Does anybody who's not familiar with the payoff diagram or the risk profile that we're looking at?
That we're showing
in
at
the
this
bottom
one
right-hand
here.
corner.
Who,
It's okay. Okay.
okay,
Yeah,
see, there are
a few people. Good.
yeah.
All right. So what we're looking at here is the market will basically we're used to seeing the market move up and down, right, with price on the left-hand side. Here, the price is on the x-axis on the bottom. So the market, it's hard to see because it's a very small picture, but as the market moves up in value, it'll actually move to the right on that graph. And what we're analyzing on the y-axis, on the left-hand side, is actually the amount of money that you have made or lost in the trade. And the dotted line is the amount of money. Okay, so let me back up. There's a few horizontal lines right in the middle of the graph, and one of those is where the market is. I believe it's the one on the right. Okay, and that's
called the
vertical line. Yeah, my bad.
The other horizontal.
And that's where the market is currently, and the other one is probably 5% down or something like that. So the dotted line then, if you match the dotted line up with the right vertical line, it'll actually tell you how much money you've made or lost in the trade. And as time progresses, that dotted line will raise up and converge into the solid line that we see, the expiration line, the triangle. And eventually it'll turn into this big hump, and you'll see a big profit zone where the market can move up, 5%, down 5%, and you're still going to make money. Most butterfly trades work that way. Depending upon how the butterfly is structured, you may make more money towards the top of the tent or the bottom of the tent. But the idea is that dotted line, which kind of raise up over time.
It's showing current price or current value as of that day.
Yes.
And the next day, that thing will transform more into the solid, sharp angled line.
Exactly.
The other thing that you can do is you can actually add more lines as well. So instead of just the T+0 line, which is today, and the expiration line, you can actually have 3 or 4 intermediate lines on there, which is used to get some outward evolve over time.
Was the left vertical line the price of the position at the time of entry?
It's at the current time, today.
So right,
Okay, what was the right?
no, that,
I asked what the left.
I think the left
line-
vertical was the
Oh, you're talking about
No,
those
no.
lines.
It was well within the money.
I'm just looking for a good one here. I
Yeah,
can't
think
find
it's
one.
5% down.
Yeah, it was something like that.
To make one little comment, because people don't know, the biggest aha moment I had starting out with these butterflies was that you can make money outside the tent. And that line out there will end up going down, but that's just the last few days.
Mm-hmm.
In the meantime, it's going up with everything else. And I think that a lot of these trades can make most of your money outside the tent.
Okay, Tom was saying you can make them, I don't know, did that come over, is that coming over in the audio? Oh, it is, okay, great. You can make money outside the
I mean,
tent,
that
right?
was the biggest aha moment I had, is
Yeah.
don't need to land
No, it's an excellent point.
Does that make sense to everybody?
Who has some questions on that?
How did we get money outside of this thing?
Well, we had a good
Well,
graph
call
up there a
it,
minute
see
ago.
that dotted line out there?
Closing early.
You don't hold till expiration. Expiration's gonna be done. If you get out 10 or 15 days before expiration, as that center dotted line moves up towards the peak of the triangle, it drags that whole line up with it.
And it's
And at the very end, it collapses these things up.
The other one.
There, that one.
There we go.
This shows it really good.
Yeah. And
So this
every
is,
day, that purple line is going to be rising, the whole line.
So if you're on the right side, for example, of that line, part of the tenth, as we call it, it's still above the zero line, so it's still profitable to you. You know, but as you approach expiration day, which is what the other solid line represents, by exiting early, you can get some profit. Not as much as if it were to, you know, if you were within the 10 area, you know.
But what it does is
but-
it gives you a zone this wide, you can make money in it.
Right, but it keeps you, you know, from losing money as opposed to, you know, making.
let me just see. if
Always better to not lose money.
So what we have here are all the different potential prices of the underlying. I guess in this case, the underlying is here, but our break-even point on the low end is here,
As of that day.
and we don't really go to zero profit until way up here. And so usually you would start with your underlying in this range somewhere, you know, and then this is a trade that somebody's been in for a while. I don't really know the exact information here, but as time goes by, okay, when you start out, this line is going to be right here, something like that, and so you'll be roughly at zero. So as time passes, this line rises, and so you can see. Now we don't know where the underlying is going to be in the future. We can take a guess, but anyway, it may go up here, it may come back here, but you can see the range of profitability. Even if we were way up here, you'd be follow this over to this axis, and you know that's 5K, that's 10. So you might be up $3,000 even way up here. You know, say the index goes to 2,200 in this case. You know, you'd be up $3,000 or so. So anyway, anywhere along that range, you're making money. So most people get trained to just look at this, and they're like, I want to be there at expiration. Well, that's great, but if you can make 10 or 15% on your money and get out and roll it to the next one, you're probably going to be ahead than if you're trying to make $20,000 on this trade, and then you know, at the last minute it goes down here, and then you're down here, and you're losing money. So anyway.
How many days do I want to be in a trade like this?
I hope that helps.
So the
That's good.
question came, how many days do we want to be in the trade? I think it depends on the strategy. So each strategy has a different set of rules. So some strategies you enter in at 56 days to expiration, and other strategies you enter in, 75, 80 days to expiration. Yeah, and others you go from 60 and you're out at 30. So they're all a little different.
A lot of it depends on how much risk you want to take. The longer you're in the trade, the more risk you incur. Basically, gamma, which we haven't really talked about, but gamma is negative in these trades, and it works against you, and gamma increases. In other words, it becomes more negative as the trade goes on. And if you're out at lunch and a work break and you come back and you only got a couple days left in the trade, you could lose a lot of money. So if you're trading full time, it's a lot easier to hold positions longer than if you're a part-time trader, you work full-time or whatever, and you can't manage your positions as actively, then it makes sense to get out and trade early.
Is there sort of a rule of thumb that like, let's say you have a 60-day trade on, all of a sudden you found that within, a week, you've gotten 80% of your profit. Typically, I would get out, and then just move on to the next thing. But are there sort of guidelines in general, like, if it's, a 60-day trade and a week later I've, gotten 20% profit, it's like I'm going, it's like, do I stay in? And,
Typically, you'll find that if you've made a lot of profit, your Greeks have changed quite a bit. And so you'll no longer be in an optimal position for the trade. So either your delta will be going bad, or your theta will be going bad, or your vega will be going bad. So, just a trade-off. And there's no universal guideline. Because Brian said, the objectives could be radically different. Two people could trade the same strategy with different sets of parameters and both be successful. And it depends also on all your investments, your world wealth, your objectives, your loss tolerance, so I don't think, but there are, yes, the answer is yes, there are guidelines, but they're all different. Everybody has their own guideline.
But the one thing that I will say is you should have your own guideline before you enter the trade. Meaning you should know when you're getting out before you enter the trade.
See, John Locke with M3, we've already, I think we covered most of that. And these are his results. And I mean, I'm going to show results for all of these trades. And, you may well have objections that these are by a quasi-vendor, so they may not be trustworthy. They may be their experience, who knows. But
and this includes commission costs and well, I got to think that what I just saw, commissions are killer.
Yeah, but I believe that we hope that these people I think that John Locke is a very honest person. In any case, we're not going to take him for that. We're just going to take him as indicative. And he shows very, very positive statistics for M3. I think M3 has a reputation of being an all-around, all-season, solid trade that has but it's not, the greatest profitability compared to certain others. And the road trip trade, let's go on a road trip for now and then come back around. And the road trip trade, let's see. Ron, do you want to read? I know you just gave a talk on it, but
sure. It's very similar, but instead of having the long call like we just studied, it's just a broken wing butterfly. So instead of being your standard butterfly, it's broken wing, and that just means that the verticals, the left and right verticals, are different lengths. You could obviously do an unbalanced as well, where you have different sizes, but that's not part of the trade. This particular trade guideline. But in any case, here you can see a picture of it. This is close to when I would get out of this trade. But if you look at the expiration graph, it's 40 points on the right and 50 on the left. You could also do it, 50 on the right and 75 on the left. It's also very popular. But the idea is to have that right hand loss. You see how it's really close, really close to zero. That right-hand line, the blue line there, really close to zero, or within 5% of your maximum loss on the opposite side. So you just take the left side divided by the right side, and as long as that's less than 5%, then it's a fairly good structure.
Because because you're going to be tolerant of being up there with a small loss, and say, well, that's so small that I'm not going to worry about it, I guess. And let me see here, go home, and then I apologize for not knowing how to operate the computer. And here's, they offer alert services also for these systems. And you could certainly at least take the trial of the alert service to get the flavor. You can get their exact order formulations, so that if you want to know how to formulate your own orders later, you can see the exact way they enter the orders. A number of these systems now have sort of stop loss or more exactly contingent orders that they're entering. in other words, if it gets down too far, then I want to immediately buy a vertical, which is one of the ones I think they're using now with Road Trip. And so you can put that in ahead of time, such that the order automatically executes. And, you know, if that contingency comes out of the blue, even on a gap opening or whatever, although that might not be the best time to do it. You know, you can try that, but I would not stick with the alert service. You can, and, you know, but it costs a lot of money. It's going to be a crimp in your profitability, to say the least.
Well, I will say they're doing some very interesting things. They've been introducing some additional hedges to the upside.
Yeah.
So they have this new in-out trade, which is basically like a condor that they lay on top. They've layered some butterflies on top. So for some of these kind of advanced road trips strategies, I think the alert service is the way to go. You can definitely learn a lot. So they keep innovating and coming up with new things to add to this trade.
It's true. I mean, the Road Trip, I mean, they keep changing it.
For the better.
For the better. But, I mean, they keep introducing these new trades. What have we gone through? Now we've got in-out trade, which only came out about 2 weeks ago. Before that, we had baby butterflies, which were added about a few months ago. And before, you know, so they keep, I guess partly it's to fight this market. In other words, the slowly grinding up market, which is not as hard to trade. And
they've also introduced some additional ways to hedge the downside too, other than just a put debit spread. I think they've added some butterflies below your core butterfly now.
Yeah.
And just to sort of play with different ideas and strategies. You know, they're kind of just beta testing some of these ideas to see what works best. Yeah.
But let's go back to why are we doing this, or what is the rationalization or the motivation or the rationale for this trade in the first place? What are we doing here? This is a broken wing butterfly in the sense that, it's asymmetric. You know, the term is pretty pretentious to call it a broken wing butterfly. It's just a butterfly, really. And other than the very most trivial kind of butterfly, which would be completely balanced. But we're selling, if you read this graph, this left part here is a credit spread. No, it's a debit spread. That is a debit spread.
The right side?
Yeah, the right side is a debit spread, meaning we paid for a vertical spread. And this part here, just on the left side, the right side.
You can see your mouse if you move it.
Okay. Yeah. Thank you very much. This part here is as we said, a debit spread, which means you paid cash net. It's a simple vertical spread.
It's because
Pardon me?
It's because you're long the one that's closer to the strike, right?
You're long, yeah, the one that's closer to the market. Is that what you said?
So you're saying you buy the guts and sell the wings?
You buy the
guts and sell the wings.
Well, you're going back to the butterfly, but I'm.
Yeah, I was just trying to summarize where you're going.
Yeah, but see, I think if you say it's a butterfly, you have to be able to think in 3 dimensions to be able to understand how it's going to evolve. And after a while, you can definitely do that.
Yeah.
You know, you can say, well, this butterfly paid $1.50 for it or whatever. It's you know, and it goes up and down in volatility. And that's a perfectly legitimate way to look at it. A simpler way to look at it is that it is a vertical spread, which is a debit spread. Now you paid good money for that, so you better be getting some value out of it.
Well, but there's a lot of different ways to construct a butterfly. I mean, you can use 2 credit spreads to construct a butterfly. You can use all puts. You can use all calls. there's a lot of different structures you can use.
Yeah, and they all amount to the same thing. They're all a debit spread and a credit spread. And
An iron butterfly is 2 credit spreads,
let's
In the
see.
call and the puts.
calls and puts.
Okay,
Same mechanics, intermediate strike. Right?
two. Okay, but so there's different structures, and you can absolutely use an iron butterfly, which means mixed calls and puts as well. But why are we selling? They all come down to selling volatility below them, down below the market. And why does it work in the first place?
Is that rhetorical?
Time decay? People are more afraid of the market going down.
Yeah.
Well, I mean, the gist of it is that, at least in the equity indices, that options are historically, chronically overvalued. So if you're a net seller of options with the right structure, then at least in theory, and based on actual historical back tests, you would have made money. That's the rationale for it. But the other flip side of that is not every option or not every underlying has overvalued options. As a result, you can end up putting on a butterfly or some other option income strategy on an individual stock of your choice, but that does not mean that its options are actually overvalued, which means you don't necessarily have an edge in your trade. Whereas at least historically, you've had an edge in option income strategies on the NDX, the RUT, and SPX.
Yeah, I mean, this is an absolutely crucial point that it's that there's a huge. That's why we're selling puts rather than or selling strikes below premium below the money. Let's put it that way, below the market, because that's the strikes that are overpriced, overvalued. I think that the butterfly is just a convenient means of doing that without taking a huge risk. It's a means of giving returns that have a degree of consistency. You could get the same expectancy just by selling strikes below the money. But this is just a clever way of smoothing it out so that you have a nice large area where you don't have a huge risk of a move every other hour or every other week coming along that requires instantaneous action.
So I heard something about Vega. Could you explain, are you looking for high volatility in these trades? Is that what did I hear that correctly?
This is a huge controversy. Some people say that you want to sell the market when it's high volatility and buy it when it's low volatility. But then you find other people who say they made most of their money selling it when it's relatively low volatility.
I think the interesting thing about butterflies in general is the Greeks kind of hedge each other to mitigate your risk. So you may have some volatility risk, but you actually hedge that against your delta risk. So you set up the trade so it's a little bit negative delta so that way you're making money when the market drops, but while at the same time you're losing money due to your negative vega and the increase in volatility.
I mean, let me ask you this question. If we look at this graph here, we always normally are above this tent in most strategies. Now, we're terrified of going down below it because sometimes the market drops precipitously and we could quickly head in a crash or even a sudden drop. We could suddenly head into large losses. So is the idea basically that we are buying protection in front of our potential loss on the analysis, on the assumption that we will be able to jump in just in time before it gets down to where it could do us a lot of harm.
So you're asking, are we buying ourselves time to make adjustments or to
Yeah, exactly.
to get out at a profit?
I mean, is that and it would appear that this is a contradiction of the of some of the model, of some of the theory of market efficiency. That you can always outrun the market. I mean, if you could always outrun the market, if it wants to crash, then that's definitely a violation, I think, of efficient markets. I mean, we've got a lot of violations of efficient markets, I realize, but it just seems to me that that is one of the more egregious ones.
Yeah, I think in general, with all of the option income strategies, the one bet is you are betting that realized volatility for the life of the trade would be less than the implied volatility at the initiation of the trade, which basically means you're selling overvalued options if that takes place.
That's the assumption, but there's another assumption too, that you can smooth the curve by getting in front of losses. Anyway, that was my oh yeah, go ahead, sorry.
You made mention of the market crashing a while.
Mm-hmm.
How do you know the market is about to crash?
Say that again?
How the meeting goes.
Well, you don't know it's going to.
Market's about to crash. How much?
Well, there would be many different definitions of market crash. Some would be over lengthy periods of time, which we don't care about because we only have a horizon of 1 day probably before we can take action. The only kind of crash that would really bother us is if it occurred in a gap overnight, because that theoretically we can get in front of all of these strategies. They see the market falling sharply. They're going to go in there and buy some protection.
Would it be better to buy potential or just the trade?
Or yeah, one form of adjustment or another. I mean, you could buy your way out of the trade, or you could. I mean, you could do various things. It's very ad hoc. That's all I'm saying. The whole thing is ad hoc, and to a large degree, and that's fine. It seems to work great. But look at the assumption we're making. We're making the assumption that we can just fairly effortlessly pull 5 to 10% per month out of the market, and month after month, with a relatively simple set of rules. Any of these, is that really likely to be the case over the long term? Or does the market know that, there's some huge crash, instantaneous crashes coming, and is that why it's giving us this gift? Anyway, I would be cautious, that's all I'm saying. Always be cautious.
To that point, how much of your total portfolio would you commit to one single road trip trade?
People say 1%. Let me think, is that right? Well, I don't know. They would, yeah. Well, people say it'd be maybe 1 to 5%.
What's the minimum on this guy?
Pardon me?
So what's the minimum you need? I mean, does this apply to any? I think on that M3 it was just set up for what, SPX options?
That was actually for RUT.
Oh, was that for RUT?
Yeah, the M3 was for RUT, and around 50K was the minimum. You can do it with 35,
Yeah.
but for the road trip, I think the minimum might be maybe 1,500.
Yeah, I would.
Very low dollars, so that means another attraction of the road trip.
You'd still need what?
The rule of thumb, which a lot of professional traders use, is they don't want to, on any individual trade, they don't want to lose more than, let's say, 1% of their overall capital on a given trade. That doesn't mean that your position is 1%. That means your loss on that trade is 1%. Now, if you're going to make that distinction, then you actually have to keep it to get out when you think you're going to get out, and that's a very important distinction.
So, and the second part of my question was, if you did 1%, then you would allow yourself, say, up to 50 trades simultaneously. and conserve 50% of your capital.
Different traders do that differently. If you got $10 million, you're not gonna mess around with $6,000 on one trade, you know. But if you've got $6,000 and that's all you got, then maybe you'll trade a little more.
If you've got $6,000, your percentage is probably going to be higher than 1%. Also.
Yeah, yeah, exactly. It might be 90%.
Okay, enough.
I know.
So I've got a philosophical conundrum for you now. So, sounds to me like you need about 150,000 in your account for you to play with this trade safely. So how do you get there if you're not like already wealthy? And if you get there by trading, why don't you just keep doing what you were doing?
It's a fair question. However, there's no one answer. It actually depends. Well, first of all, you might make. There's no one answer. You may view it as tuition,
Yeah.
and so you may increase the amount you're prepared to lose. I think the answer that was given was in a theoretical sense where you're managing a large portfolio and looking at allocating how much capital to allocate to different trades. I don't think it is an absolute limit at all.
Seems like a good idea, though, to minimize the risk.
Well, yeah.
SPX is a big product. Is what? A large product, position size. I found I'm not able to trade SPX because of the size.
Well, the price of the underlying is high, so the price of the options are high. So, I mean, that's an advantage if you have the capital because it significantly reduces your transaction, your commission costs.
If you're trading big bucks, it's almost the only product.
Right.
If you just want the experience, you can trade
Why?
the ETF, SPY.
The $5 float on that so low.
Yeah.
Get much.
These days.
So here's the returns they're listing. And they were higher on the road trip. They were higher earlier, but it's because, in general, implied volatility is lower in the current market, and it's a hard market as well. And those were Ryan's results. Not to skip over them, they were excellent too. Here's what John Locke said. He said the road trip trade is essentially a broken wing butterfly with a no-roll risk-off adjustment strategy, which is just referring to the fact that with M3, he rolls up, whereas they do not with M3. And Kevlar is a trade by Jim Riggio of Capital Discussions, and he has split it. He says for a low-volume environment, he uses a symmetrical butterfly, and for a higher volume, higher volatility, of course, environment, he uses a broken wing butterfly. He's a principal of Capital Discussions, so this would be an alternate version of these trades. I mean, it's somewhat similar to both of them. And this gives specific trades. So if you want specific trades, you could follow some of his stuff. Now, it's not very open. For that one, it's not as open, I should say, but as road trip. But nonetheless, you can get a lot just from looking at his video, which I've listed here if you want to look at it. And we're running short of time, so I'm not going to go into any detail, but he shows higher returns from his more customized version, which incorporates ideas from M3 or similar to M3.
I have an idea that Jim specifically chooses his strikes based upon the valuation of the implied volatility and the overvaluation of price.
Yeah, and on the skew.
Yeah,
very
he's
specifically.
very meticulous about that. That's
Yeah.
the general sense that I get. I have not taken his course, but
Yeah.
that's probably one reason why you get such great returns here.
Another very interesting person, if you want an alternate to get away from the mainstream a little bit, but not too far. Amy Meisner has the Weir door, and she has very, very specific recommendations. And she hasn't really changed them too much either. I mean, the Weirdo was originally not invented by her, but she's adopted it. And you can look at her videos, which I've, I hope I've given some pointers to. Yeah, and yeah, she had a good one, Options Tribe. Now this one has some variations. You can see here, if you look at this graph and the
so this is Option Net Explorer we're looking at now.
Yeah, yeah. You can see that she has additional debit spread as protection below the money. Would that be fair? And so she has she also has very precise rules, exact to the percent, and she has lots of orders in the market. And I'm sorry, contingent orders, always sitting in the market. So they do things like add additional positions. So she's a very, very clear speaker. And she's, she's totally honest. So that's another variation on this initial set of spreads we're looking at. And so I have some details here. And now we come to one that is a little bit off the beaten track. And as a matter of fact, you won't find any webinars in Capital Discussions on this one. But some of us have been very attracted to it because it is very, very simple. And arguably gets rid of needless complexity and needless adjustments. It's almost no touch, which would mean you put it on and you don't adjust it. As a matter of fact, it is no touch, but you do take it off if it gets out of line. But that's all, and then you re-enter immediately. Mark, do you want to say?
So I'll talk about that one a little bit. I've been trading this one exclusively, and this graph is a little bit deceiving because it is all scrunched up. If you the 20, 40, 60 corresponds to the deltas of the strike prices that you pick initially, and if you think about it, you're selling twice as many in the middle of your butterfly as the two wings, and so that corresponds with the 40 strike in the middle. And so 2 times 40 is 80. Okay, 60 plus 20 is 80. And so when you set your butterfly up that way, you are pretty close to delta neutral at the outset, and you have a very wide butterfly that is pretty resilient to moves either way. And I haven't been doing this that long. Since the middle of December, I put some trades on doing this, and I'm still in the trades. I'm up 15%, and I'm sitting on it right now, and I'm still in a very comfortable spot with the trade. And if it goes too far in either direction, I'm just going to close the trade down before I'm losing money and put another one on. And so there's no adjustment strategy really. It's just put it on and take it off. If it goes too far to the downside, you probably just need to move the whole thing down. If it goes too far to the upside, consider just moving the whole thing up. Take it off and put another one on. No complex adjustment strategies, no complicated calculations and bookkeeping,
What's the other one?
SPX, but it actually works in anything pretty much. I did one in Amazon, you put them on in the Russell if you'd like. The nature of picking your strikes according to the deltas is really neat. The guy who came up with this said that it is self-adjusting with regards to days to expiration and volatility levels at the outset when you initiate the trade. No matter what, let me see. A high volatility, I think, gives you a wider butterfly. Low volatility gives you a narrower butterfly. And so it's somewhat self-adjusting, at least at the get-go.
Did you say how far out your expiration was?
I put them on 60 to 80 days. I would not go under 60, and you'd like to be out with 30 days to go, probably, unless you're, a little more daring. You might ride it to 20 or 15 days to go, but definitely get out of this before.
And the reason he does that is to reduce your gamma risk.
Yes.
If you're up 15% already, you don't want to put the trade out, or?
I could. It's when you got something that's making money, you're always tempted to let it ride a little longer. I'm very comfortably under the profit tent. It would take a move 50 points in either direction to really get me nervous, and I would still be up money at that point. So it's just a very comfortable, trouble-free trade, and I feel like it's really a perfect trade for somebody with a job because, day after day goes by and there's just nothing to do. So it's almost a boring trade, but it's very safe. The guy who invented this, Andrew Falvey, he's a fund manager, and, his philosophy is, if I start showing losses, I'm going to lose customers. And so, he's very risk averse, and, he wants to get out of this well before being in a losing situation. And
What's the typical cost of that?
you can do a one lot in the SPX for typically around $3,600 to $4,000. And
Michael had a question.
sure.
Well, the question was the days to expiration, and we just covered.
Okay, cover that. Okay, there were other questions here.
You kind of answered it. I was wondering the wiggle room for the body.
Quite a bit. It's a very wide butterfly that this formula produces, and like I said, days and days go by, and there's just nothing to do. I've been in this trade 22 days. I just do other stuff, or I, watch trading videos, or.
Where's the market?
It's usually in the upper third of the profit tent there.
Do you have any rules on that?
Probably, yeah.
Don,
Yeah.
do you have any adjustment rules on 60/40/20?
There are no adjustments.
When to get out? When to
Oh, yeah, that's absolutely correct. What he suggests now for 60/40/20 is, I'm completely lost here, please don't, here we are, is,
I can talk
exit
about
and
that.
re-enter if the near or middle, delta changes up or down by 20%. And by the way, I just heard a talk by him yesterday, and he said, really he's revising that to say if the short strike is, in other words, mainly focus on the short strike, and if its delta changes up or down by 20%, then exit the trade and re-enter it. But the next month that has 60 days or, no, it'll be 90, or whatever your horizon is, days or more.
Well, I've heard him use 30% as the number too, as well. And then, one of mine I was managing, and it hit 20%, and I was still very comfortably under the profit tent. And so I said, let's just hang on and see what happens. It pulled back well within 20%, the next day. And so,
sure.
I think it's kind of a gray area. 20 to 30% is probably, maybe 20% is your caution zone, and then 30% might be definitely go on and get out.
So just so that we're all clear, this is percent change of the original
Yeah.
delta.
Of the center strike. So the delta on your center strike when you begin would be 40. And so if that number changes up or down by 20%,
From the initial value.
You mean up or
From
down
the,
by 20 or up or down by 20%?
So if it gets to 48,
20%,
48.
if it gets to 48,
48 or
or 32. That is, and he used those numbers, they're getting familiar to me.
well, it's also nice if you apply it to the upper strike, 20% of 60 is also 48.
yeah, I've heard him say watch the center and the upper
So-
strike, but maybe he's just focusing on the.
Well, I just, yesterday he said he's focusing on the center one now.
Okay.
And get this, you can use these other, for a more conservative trade, you can use 50, 30, 10. For a more aggressive bearish trade, you use 80, 50, 20. Anyway, so this is something you could, it's all so simple to explain. You can play with it yourself. You won't be dependent on any alert service or any complicated set of rules. And I almost would put it as number one, except that it doesn't have the community, the support. You know, you won't find very many. There is one webinar on it, which you can get, which I've given the URL here for. And if you take a free trial of Options Tribe.
He also spoke to our community a couple months ago.
Yes.
And we have that, no, we don't have that recorded.
Unfortunately, we had technical difficulties. But this one is fine, though. It's okay.
Yeah.
He just gave another one yesterday, but it wasn't on this. It was on a lot of different things.
Do the numbers also work on using like the SPY?
Yes.
I mean, because that would require less capital.
You can do them on the SPY. They just worry about the commissions, that's all. But
Yeah, the commissions get to be cumbersome, trading that small. But you could pick something else like, you know, I did one in Amazon and it worked out fine. You know, so, you know, it just depends how much money you've got, I guess. And but I found it a very resilient trade that is pretty trouble-free and allows me to go biking in the middle of the day and, you know.
Tentatively, I'm planning on trading it also. Matt Williamson has fruit fly. I just want to briefly cover the rest of those, and then we'll go to the other brief talk, unfortunately. He has fruit fly, which is similar to road trip, but on a shorter time scale. So if you want to try and drive road trip faster and make more money faster, you can go to look at fruit fly on YouTube, free video. That guy will talk, you know, he's very open. He's just starting out in a way, so he's got fairly good results. Another one then we have is, I knew Bruno Voisin has a Rhino strategy, which is another capital discussion strategy. It's a combination of broker wing butterfly calendars and call a broker wing butterfly. So if you want to mix in a calendar, which gives you the possibility of getting positive vega, then which could be very useful on occasion if you want to try and benefit from an increase in volatility that you see coming, then you could look at this strategy. I'm zooming through these now. I'm sorry. John Locke has super simple spreads, one of which is the bull, and another which is V Condor. Tom has looked at least. I think you've traded. Have you traded the bull, Tom?
Just finished a year.
1 year worth of trading.
1 year worth of trading, and I want to have a meeting. Go into that in depth in a future meeting. But for now, you like it?
Oh, yeah.
It's not the same type of trade at all. It's not a butterfly, I should say. Not a butterfly. It's quite a simple trade. And he also has V Condor, and he goes over these in his weekly talk, Monday morning talk. And I just want to mention, before we go switch to the other topic, I just want to mention risk. Don't be careful of risk. And when you say income strategies, some people think of like bonds. It's not like a bond. It has a high degree of risk. So although it is an monthly income strategy, it is not a conservative monthly income strategy. And it's not suitable for a lot of uses. We'll have slides. I'll have the slides for you. Remember, if you lose 50, this is Evan Rothschild, if you lose 50%, you need to get 100% to make it up. If you lose 80%, at any point, you need to make 500% to make it up. So really, the kind of losses we see in many of these systems should cause you to probably reject the system or devote such a small amount of capital to it that it is only being played with effectively, or a small part of other strategies. Be careful about that. The Russell ETF dropped down 7% on 9/11. RUT. Google call options went from 10 cents to $80 on one particular day. Imagine if you were short instead of long. And the Swiss franc went down 20%, and that was a gap. It went down and up, both, as they went on and off the peg. And Ron Bertino has a hedge that we're looking into, which we won't have time to get into, but it basically involves a very far away from the money ratio. Well, it could be a ratio, but it can also be a condor. And so for people looking for that and for hedges, that's another topic we have to get into. We won't have time today. Now, we'll have to leave it at that in order to have a little bit from, I think we can just keep recording, and to have a little bit of talk from Sagar. Sagar, do you want to tell us a little bit about your trades? Do you want, if you want to call up a web, Ryan can call it up for you. You can do it. Do you want to need the website or?
No, on my.
Oh, on yours? Okay, we'll do that. While you're plugging that in there, we'll just talk about something else for a minute. So does anyone have any other comments while this is cooking up? Yes. About once a month. We have to contend with the library's scheduling process. Very difficult to deal with. So we handle it with any kind of.
Is that HDMI or VGA?
Oh, well, we have a wide horizon. We cover a lot of different things. We're accused of being too much oriented toward options right now, but we will do some other non-options trades as well. Yes.
I'm a beginner, so I wasn't going to ask questions. A lot of smart people here, a lot of information. I'm just starting out researching. I got development videos, and I got the book, Written Options for Dummies. It's not, I don't like the way it's organized at all. Did you or anybody have a recommendation for a good way to, begin learning? I mean, maybe some good texts or.
I don't think there's anything, to be honest with you, that can compete with videos. It's strange. Ryan, would you agree with that?
I learned a lot from video. I mean, there are some great books. Mm-hmm. Brian's written a few great books. He's in the room here.
That's true. Brian has some good books. You can look at those.
For me, I like the video. I mentioned that earlier. I do it back there on YouTube. I can,
Don't search for YouTube. You'll get junk. About 99% of junk. You have to go to these selective sites that we're suggesting, or maybe somebody else has good sites. If you go to YouTube, you'll just get junk. It'll be completely wrong, fraudulent, and just completely misunderstand. And the other questions that you may have is, whether you can trade simple spreads or whether you have to go to more complex spreads. But we better leave that for now. I mean, I personally doubt that you can do that.
That's
But, paper trade.
No, you're gonna have to go, talking to them.
Yeah, it's above law.
I-
But if you become profitable,
We can't-
let's say
okay, we'll
after
have
2
to-
years, then you can start putting money in. That's.
And then you'll start becoming.
What can we?
What it is, what they did not go into was emotions.
That's,
And that's the biggest thing, is, the emotions is, that'll make you lose more money than anything else. Is your emotions.
Absolutely. Sagar?
Good evening, everybody. Thanks to Don and other organizers for making this event possible for us, and thanks to all of you for giving me a chance to share my trading approach and few of my trades. I am Sagar Nandi. I am the Chief Analyst and Trader at Superior Profit. It's a company based in Singapore. I trade in multiple countries and markets, including USA, Singapore, and India. We have few traders who trade in Australia, other Indonesia, other countries. I share my trades regularly, trade ideas. It's not trade alert, it's just what I'm looking at, and allow me to sit down so I can use the mouse. These are open to public. Anybody can go and see. There are sometimes trade ideas on stocks, sometimes options in multiple countries. And I also conduct a live class for the people who use the same trading system that I do, but it is open to public again. Anybody can go and register. We look at the trade ideas that we shared last week, how they performed. We look at broad market internals. Based on market internals, like 52-week high-low, advanced decline, up-down volume. We look at sector and strategy, how they are ranked. There are 160 industry groups and 10 sectors. And we look for potential trades in upcoming week. Now, what I'm going to share with you today is some of the trades I put in US market, which was posted in the traders community as I was taking it. Not as an alert service again, it's just my trade ideas that I am looking at. And then we always follow through on that, so I will go through that. Before I do that, I need to go through the disclaimer. The demonstration is for educational purposes only. It is designed to share information on Superior Profits trading system. The information presented here should only be used by people who are aware of the risk inherent in trading. Past performance is no guarantee of future return. Superior Profit is not an investment advisor. This is not a recommendation for buying or selling stock or any other instrument. Superior Profit will have no liability for any decision made by its audience. Okay, now that's done. I don't like to use the slides, so I will use the whiteboard and write. After that, I will go to the actual trades that were posted. I need to give some information on my trading approach. I trade at the edges. My handwriting is not good, but I'll try to. What I mean by that is that, and by the way, I'm loving this Microsoft Surface Pro. I like to buy low, sell high. So to me, that's a way of trading at the edges, or short high and cover low. And this approach allows me to trade all the instruments, whether it is stock or futures or options, directional option trades. And that simplifies my life because in my retirement account, I am a resident of Singapore. They allow only investment in stocks, that to Singapore-based stocks, not that liquid like US, and the brokerage platforms are not good. But anyway, I'm restricted to that. If I keep the money in retirement account, Singapore government gives traditionally about 3 to 5% per year. So my target is to get more than that. I think I can comfortably get that by buying stocks even in the Singapore market. And we are sharing those trades also. The other part of my approach is that I trade in all market situations, directional trades, but all market situations. The first of them is, of course, the trending market, where it makes successive highs and successive lows. And I wait for the price to come down and just starting to go up. And I take a long position, either with stock or with a long call or call vertical. That's probably the maximum complexity I go to. Then I trade in a reversing market where after a prolonged uptrend, prolonged is subjective, it starts to topple over. There is a trading signal that comes in our system called headwind. Based on that and few other systems, sometimes we take a reverse trade, like a put or shorting the stock or ETF right at the top. I'll share some example of all of them. The third setup we use, market situation, is when the market is moving sideways. Instead of trying to take iron condor or calendar spread, etc., we try to wait patiently for the stock to go up inside the range and start sticking down. Then a down arrow comes, and if it is a fake upside breakout or if it is a fake downside breakout along with high activity, and this arrow comes, we place a long stock strategy or just a simple call vertical or short put vertical. So in effect, you can say it is an iron condor, but instead of putting on the iron condor when the price is middle in the somewhere, we patiently wait for the price to go to the edges and place each vertical leg one by one, and that strategy seems to work for some of us. And for all this, there is another market setup. Sometimes a stock goes up and comes down, hits a predefined or pre-visible support or resistance, and again starts to go up. Then we take a long position again. So in all of these, if you see again that I am trying to buy low, sell high, or short high, cover low. And whether it is using stock or options or futures or forex, we use the same strategy. And I use the same strategy for long-term investing, for swing trading as well as day trading. So let us go through some of those trades that were shared in the community and then see how they perform. I'll not go through the slide. I saved the link of the post, so I'll just go to the website. Okay, there was a blog. Sometimes after the trade is over, I may write a blog, but I would like to go through the actual community post. These are, I like to come to this session whenever I am in US because I learn a lot about options. But I'm a very simple trader, just long call, long put, or maximum, as I said, I can go to verticals. And it's a directional strategy, works for stocks. So this is a trade on BlackBerry. And I mentioned about trend following trade. So this was a go with flow, we call it's a trend following name, a trend following short trade. When the trade was posted, our chart looked like this. Now on the left hand side is the weekly chart, and on the right hand side is the daily chart. And I love Microsoft. This is weekly chart, this is daily chart. We have a set of checklist based ways to look at the chart, and that rule says on the daily chart, if it is making lower high, lower low in the very short term, and if there is a magenta color candle, we call flow is bearish, then take a short trade. That's all. And weekly, if it is magenta, that's also a requirement. So we are trading when the weekly is aligned with the daily. It's very simple. Go lower high, lower low is coming. Then, as I mentioned, when it is coming down, I wait for it to go up and tick down. And that is when this magenta candle comes. So at that point, we took a bearish trade, and it can be taken with any instrument. But in this case, it was taken with a vertical. Right? It's taken as a vertical. If price goes down, then we'll make profit. If price goes up, it will make loss.
Can you show the strikes and how you chose them?
Yes, yes. It is usually I try to set it as $1 risk to $1 reward. But if I am more aggressively bearish, like in this case, maybe then I will put more reward to risk ratio. Yeah. But if it is a short vertical, then of course the reward risk ratio is not 1:1. In this, usually I just I'm very visual person and I'm not that much into theory of options. So I try to draw the at the money or near the money vertical and see how my reward risk is stacking up. On Thinkorswim, I move my cursor left and I see my maximum profit. I move my cursor right, see my maximum loss. If it is acceptable to me, I take. So if it is a long vertical, either call or put, usually it is around 1:1 reward risk ratio. With commission spread, it may be slightly lower, but that's the thing I target.
But you say near the money?
Around the money.
Mm-hmm.
But if I am more aggressive, then I may trade it with different strikes. But the starting point of my drawing this risk profile will be at the money, around that money. But it is it's basically a bearish trend. So what happens then in this particular case, and all these are posted as and when they happen. So after a few days, it came down, and it's a short-term trade, swing trade. On average, our swing trades last, on average, I have seen about 5 days. So if we are going for a swing position trade, I buy monthly option. If I am taking a day trade, then I use weekly option. Yes, please.
Can you talk about your stop losses? Do you have them?
Which one?
Stop loss.
Stop loss, yes, yes. Now, if I am trading stock, let me, because this all came from my stock trading background. If I am trading stock, then on the chart.
No, I'm sorry, stop loss. Like, is there a percentage of the.
I got it. Yeah, I'm coming to that. If I am trading stock, I can.
You say stock or stop?
Stop loss. Yeah, I got that. Stop loss. I got that.
On the stock. So, or on the value of the stock or on the value of the option?
Stock trading and how he applied that to options.
Yeah, I got it. Stop loss. Let me get it. Yes. Now, I sometimes use TradeStation, sometimes use MetaStock. So let me just show using TradeStation for now. Let me maximize it. So if I am trading stocks, say BlackBerry, then based on this magenta color, etc., I take a trade. And if I'm trading stock, I can change the template, and based on the volatility of the stock, not the implied volatility, how wildly the stock is moving, the stop loss are calculated. That is for stock. But for trading options, if I am trading vertical, sometimes I don't put any stop loss. Yeah, mostly you can say, unless I have a very different view of the instrument since the time I put on the trade. If it is a vertical trade, I don't have any stop loss. Average holding period is 5 days, and the examples you will see, they will usually work out within 5 days. So there is no stop loss in this vertical spreads. Now, in vertical spread, usually in my trading, I risk no more than 2 to 3% in one particular trade. And if the success rate of the directional strategy is more than 60, 70, 80%, then we don't have to worry with vertical spread. But if it is just call or put, then of course the time decay will also come into picture.
Is it a debit or a credit?
Sometimes I do debit, sometimes I do credit. So I will show example of both. If I am more bearish, I may just do debit. But if I am not so comfortable, maybe right now, like the market is going up, but there may be a bearish trade on a particular stock like BlackBerry. I'll share another example of BlackBerry trade taken recently, just after earnings. That was traded using short call vertical, a bearish trade, but short call vertical. I think this was also a short call.
And this magenta color is your proprietary indicator that you came up with?
True. It's coming from the trading system. However, it doesn't need to be our trading system. If we have some understanding of the support resistance, the approach that I am explaining can be done by anybody. It's not necessarily tied to our system. It's not that complicated. Of course, I love my trading system.
Without giving away the secret sauce, what is
Mm-hmm.
the trading system around? What kind of concepts?
Many. So, if you are interested, I am, again, it's not about the trading system. If you want to know about the approach, I'm always happy to do a webinar. Nothing to do with the trading system. And the concepts can be applied by anybody, with or maybe with their own systems. Yeah. Now, coming to this, when I take off the trade, we also have, we entered the trade in this case on this magenta candle, daily chart, and we put on a vertical trade, and then we have all these automatic smart trend lines. We may call it memory line, but it's basically very smart trend line with anchor points that can come from few days back to few years back. They automatically get redrawn as the chart progresses. So that will be our target point for stock. So for option also, we book profit there. And another thing you will see in my vertical trades, as soon as my entry is filled, I tend to place a GTC order to book profit on half position at 50%. So if my debit was 50 cents and I place a GTC order to come half position, 75 cents. And then if it is 75, another GTC order I put at 75% profit. And the same thing is true for both credit spread and debit spread. So I place the order, I don't have to stay in front of the terminal. Now this was one trade then where we had a trend following trade taken using this magenta color symbol. That's the flow color bearish. We also had some support from the resistance memory line. That is good. And we also had high activity when the price came down. So this trade worked well. And this is from Thinkorswim snapshot. Initially, there was a credit of 14 cents. This is actually just after the recent earnings. It is also, it could be also called a bounce setup, but it's okay. Initially, there is just 16 lots at 14 cents credit. I placed a GTC order to exit half, 8 lots at 7 cents. Then another 4 lots at 75%, about 3 cents. And the last few lots I am still holding. But I know because it is vertical, even if BlackBerry for some reason goes up, I have a risk-free trade from now. Yeah. So this was one trade, and let me go through a few others. This was also.
We have to be fairly, we have to wind up in a few minutes.
Okay.
Sorry.
No problem. Then I will not go through the. There are few swing trades and there are maybe one day trades. Let me just go to the day trade. And I can share the links. You can go through them later if you want. Now, I would like to show one. I can, yes, sure. Okay, let me show you the other kind of trade. That was taken on SPY recently. You can see SPY made a chart formation like that. It's around 19th of December. And I was talking about a reversal trade, and this diamond magenta comes up. That's a bearish signal. So based on that, I took I think again a short call vertical bearish trade, and I put my profit taking order, and it came down enough to give me a good profit. Again, these are very short-term trades, and you can see. Initially, I started the trade with 51 cents credit, and immediately I put GTC order for 3 lots at 25 cents, and then another half 3 only, 2 lots at 12 cents debit. So I booked again half profit at 50% profit, another quarter at 75% profit, and the rest I just left. I thought it will expire worthless. It didn't expire worthless. SPY went up, so I had a small loss on the last remaining lot. On net position, I still had about 38-40% profit in 3 days. This is short call vertical catching the very peak, and there must be some day trade. Okay. There are blogs, but I will not go through the blog. I'll just go through the community trade. Sometimes when I'm trading, I keep an eye on the 3 ETFs, SPY, QQQ, and DIA. And if I see one is more bearish, then I trend to short that one. So on the left hand side here, it's a chart of DIA daily chart. This is daily chart and this is 5-minute chart. Now on the daily chart, I observed just a few days ago that there was a resistance memory line. It's a kind of smart trend line. And I saw that price opened little bit higher. Actually on intraday chart, you can see slightly higher. And early range formed in the 5-minute chart after the trading started, and it struggled to go up. And when I looked at DIA here, DIA and QQQ, DIA, QQQ, SPY, I saw that DIA couldn't go up. Little bit QQQ went up above early range and little bit SPY went up. So I shorted DIA. And because it was meant to be day trade using 5-minute chart now, so I traded using weekly option, again simple call vertical. Then I had a credit of 41 cents. Then at the end of the day, on that day, I placed the trade around this time. At the end of the day, it was supposed to be day trade, but I saw that the daily chart, this is not daily chart, but the daily chart memory line here was not violated and it didn't go above the early range. So I decided to hold on to the trade. It had 2 more days till expiry. And next day, it fell, and I always have a GTC order to book half profit at 50%. That was triggered. That's fine. 20 cents. I bought back half. Then it fell more, and I always have another quarter position profit taking order at 75%. That was also triggered. So I think again the last day remaining position I left and market went up, so I had a small loss on the remaining position again, but still it had about 40% profit. So that's in summary how I trade, whether it is stock, future, options. I have a directional outlook on the instrument. It is at the edge. It can be sideways move or trend following or trend reversing, and I just trade it with stock, future, anything.
So it looks like your GTC orders sell a portion.
Yes.
So you got 2 portions of your trade going, and the last portion, what percent? That the one that ended up going to.
Yeah, in all the examples I showed, I just risk a fixed amount into each trade, say 2 to 3% of my account. So if it's a 30,000 account, then 2% is $600. So whatever be the number of lots I can buy with that, I buy.
What is it? But your GTC closing order, you set like a third of each third of that 600.
So I write it down.
Because you said you sold the position twice.
Yes.
A GTC
So
good.
if I had 10 lots in the beginning,
Yeah.
then 5 lots I sell at 50% profit.
Okay.
Then another half of remaining position, so in this case it will be 3 lots, 75%. And the rest I try to ride, whether it's fall vertical or short vertical or long. Yeah.
Very good. I'm curious about your company. Now you said, were you a student here yourself, or?
Actually, I am originally an IT professional. Last 2 companies
Oh, that's right.
worked for was a vice president of Oracle Corporation and managing director. Last job was managing director of a German company, multinational. But I always liked freedom. And my wife works here. My son goes to Chapel Hill. My parents live in India, and I was in Singapore for many years. So I decided to leave job. And
Yeah.
it was just for my trading. Then some of my friends, MBA, I did MBA from Singapore. Executive MBA, they came to know, so they told, you are not running it as a company, let us.
And you trade markets, you trade the Singapore.
I have the benefit
And
that
the
I am
Asian-
resident in Singapore, and the retirement money is stuck there. Actually, I have some interesting data on it. Even in the dull market, it is not difficult to make money. For long-term investing, there are using the same system we do.
In Asian markets?
In Singapore market. Asia, India also. India
All right.
is actually more active than Singapore.
Have you heard of any Americans managing to trade who don't have ties, let's say? You already probably, you may have ties back there, but for somebody who is not, doesn't have any ties, Have you heard of any ways for insular
In
Americans
India,
to
not
trade internationally?
possible or almost impossible. In
Yeah.
India, almost impossible.
As soon as you come here, you get a green card, you have to,
Yes.
you cannot have a brokerage account.
Even for non-resident.
Yeah,
So I'm
non-resident.
non-resident, I have to use my mother's account.
Exactly. I just tell my dad to trade.
But the Singapore has no capital gains tax.
Yeah. But many trades many of the Indian companies do trade in NYSE.
Yeah,
ICICI
yeah.
Bank
And they have those, what are they called, exchange certificates?
Exchange,
or-
So there are ETFs and other.
Yeah.
ADRs. However, I see that it's much easier to trade in American market. Liquidity
Yeah.
is much more, the spreads are very narrow, commission is very low, and much more information is available.
But one of the big frustrations for Americans is they can't trade options. Even when you can trade stocks, foreign stocks, which you can for a number of indexes in particular, for futures, and you can't trade the options.
Yeah.
You can never trade the options, which is just absolutely ridiculous. And we got to figure some ways around that eventually. But your company, what is the net? How is your company's business doing?
I frankly don't know the number of customers.
No,
I
I'm
don't
not
track.
asking the number of
I don't
customers,
track.
but is that working out to your satisfaction?
Yes, it was my hobby, and for me, it is still my hobby.
Okay.
I don't, I have the designation of CEO, but I don't look after the company. My MBA friends, they are business people. They are tycoons. So they look.
Oh, they're tycoons?
They are tycoons.
Who has developed the trading platform?
Few people, but mostly my idea.
So what are your objectives for your company?
Not really much. Personally, I am just free and happy to travel around between India, Singapore. I have a house in Thailand also, and of course America.
But you're making enough money out of it that you're confident you can continue to do that.
This company is run by my MBA friends. They are tycoons. They have put money in the company and they take care of it. They are tycoons. They are Chinese tycoons. So no issue.
Well, let's give them a hand.
Yes.
And Matt, thank you everybody for coming. We're going to continue.
Thank you very much.
Can you stop the recording?